Good morning, ladies and gentlemen, and welcome to the show. Listen, I'm glad to have you guys here. Today is November 5th. It's a Tuesday, and let's get started. Let's open up the charts right here and take a look at what's going on. Guess what? They're driving the silver price and gold price down again. Silver is $17.71. It's taken a precipitous drop in price today. You know, some of these market riggers and stuff, they're now, I guess, they're leading toward criminal prosecution. They've proved that the market is being manipulated. And what I'm seeing here is I'm still seeing this action going on of them driving the silver price down like a spike, Are they still rigging this market? Because it's been proven that they rigged the gold and silver markets, But here we see this price action. They're slamming the price down again today. $17.71. I don't like to see this happen, but it does create buying opportunities. Let's take a look now at gold. $1,492, and it's slammed down too. $16.90 down today. So it's back down under $1,500 for gold. And it doesn't look good. It looks like it might even go a little bit lower today. By the way it's charting here. Now let's take a look at cryptocurrency market capitalizations. $251.7 billion in cryptocurrency. It's been moving up. It's been creeping upwards ever so slowly in price. 67% Bitcoin dominance today, and we see all the coins are up. Do not make any mistake about this, guys. Cryptocurrencies is just as much of an asset as a way out of the dollar as gold and silver. And these two things, cryptocurrencies on one side, gold and silver on the other side, it's just like they're in some sort of a wrestling ring, And one gold and silver is on one corner, and cryptocurrencies is on the other corner, and this is an all-out between the two of them. And to investors, they see gold and silver being pinned to the mat over and over and over again. They're going to see gold and silver as the losers. When cryptocurrency keeps creeping up and going higher and higher, people are going to start to see cryptocurrencies as a winner. And this could be a huge difference for cryptocurrencies. If cryptocurrencies continue to move upwards, people are going to see that as a winner, and they're going to hop on board. This is just human nature. People always root for the winner. They always go with the winner. They're always in the winner's camp. The loser's down there. His face is in the mud. He's been beaten. He's been broken. He's got a black eye or whatever, and nobody wants anything to do with him. The winner out there, they're all surrounding the winner, and they're holding his arm up in the air, and they're chanting, yay, 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 to the winner. This is a race to see who's going to be the winner, Let's not forget that. Let's take a look now at the Dow Jones today. Now, the Dow Jones is up 20 points today. It's been going up and up and up. It's been being a winner and a winner. But it's in such a hyper bubble, it's unbelievable, guys. Now, I'll tell you what it's like, the Dow Jones right now. Pretend the Dow Jones is a drunk climbing up a water tower. And the people are all standing down below. How are we going to get him down? How are we going to get him down? Some woman screeching, he's going higher! Oh no, he's going higher! One guy down there is looking up and he's saying, oh, he'll never fall off. He can climb forever. Has a lot of confidence in the drunk. Well, there's people in the markets out there looking at this market and they're saying, oh, it'll go up forever. It'll go up forever. Other people are looking, oh, no, it's going up higher. Oh, no, it's going up higher. Well, we all know how that's going to end with the drunk climbing the water tower. I mean, he can barely stand up. And it's rained the day before. It's rained all morning, and the water tower's all slippery. The steel rungs in the water tower are all slippery. And you know what's going to happen, guys. It's a no-brainer, and that's with this market right now. It's just like a drunk climbing a water tower, honest to God. Let's take a look now at crude oil. 52 cents up today. on the day. 57.06 for sweet light crude. That's what we see going on there. Now let's take a look at U.S. Treasuries. Just a sec. Let me pull my chart in a little ways so we can see them better. We see yields popping up there again. And, you know, these are substantial yield climbs, what we're seeing. We could be starting to see a trend, you know. I've been talking about this for a while, that all of a sudden the bond market might really have a convulsion, you know. And right now we're seeing quite a strong move. We're seeing 5.3 basis points in the U.S. 30-year and 4.7 basis points in the U.S. 10-year. So we're looking at a 30-year at 2.32, and we're looking at a 10-year at 2.83. The only part of the yield curve that's falling a little bit is the 1 month. We're looking at a 2.6 basis point fall on the 1 month, 1.56 on the 1 month Treasury. Let's take a look now at the dollar. And this is part of the reason why gold's fallen off. The dollar's been going up this morning a little bit. But, you know, the dollar has been going along basically sideways for the longest time now, the U.S. dollar index. Now, I want to point something out to you guys right here. I want to show you this woman. Claudia Sahm is her name. And she is an economist, and she is currently section chief at the Board of Governors of the Federal Reserve System, where she has worked since 2007. She specializes in macroeconomics and household finance. Okay? Now, let me take a look at this article here in the Markets Insider. And they talk about the quickest way to spot a recession according to research, new research by the Federal Reserve. And they're talking about her in here. And they say it often takes years to officially declare a recession. According to a recent paper by a Federal Reserve economist talking about her, they proposed new ways to spot and address the recession more rapidly. So, in other words, they can get on top of it quicker. And the thing I'm getting out here is they've called it the Sahm rule. That's her last name. The thing I want to get out here, the point I want to get across is, let me see, they're talking about stimulus. They're actually talking now about, and she's probably not the only one in the Federal Reserve that's thinking this way. We're seeing a change in the way of thinking. They're seeing that the end of Keynes economics leads to a point where you actually have to stimulate the economy by putting the money directly into the economy. This is the final conclusion. This is the final part of Keynesian economics that leads to the hyperinflation. But it's the only direction that they can go. In other words, to stimulate the economy, but not by quantitative easing. That becomes pushing on the string in the end. It becomes so ineffective in the end, completely ineffective, because it only puts the money into Wall Street. It doesn't make filter its way into the main part of the economy. So now the economists, Federal Reserve, they're starting to change direction. They're starting to think this way. And they're saying here that fiscal policy is normally very slow to respond to a recession. It also, they're using a little bit of kind of hard words to understand, but it says policymakers view in the United States as running out of physical space. What they mean by that is the same thing I just said, pushing on a string, or becomes ineffective. So what they're talking about in here, right here, it says, as part of the proposal to the Federal Reserve, Sahm outlined a system that would distribute payments to households once the recession indicator flashes. In other words, once they see an indicator that we're going into the recession, then see what it says here? Distribute payments to households. It says these would be issued by the Treasury Department and equal 1% of consumer spending. See, consumer spending all the way across, if we were to lump all consumer spending together across all of the United States, that's a huge amount of money. 1% of that would still be a huge amount of money. But that, how the government works, they always start, like if they're going to tax you, they'll start with a 1% tax, and they let everybody accept it, and everybody's good with it, And then they up it to 2%. And then the next year they up it to 5%. And then the next year they up it to 10%. This is what they always do, see? And so they're talking about 1% of consumer spending. They're going to issue these payments by the Treasury Department. Well, you can bet as the economy gets worse, that 1% will move to 2%, and then 5%, and then 10%. And in the end, they're going to be issuing money by the Treasury Department, and they're going to be supporting all the households across America with freshly printed money. Can we say hyperinflation, guys? Because when they start all these programs like guaranteed basic income and money, just sending you money in the mail, when you go and cash those checks, don't put your money in the bank account. Because it's going to become worthless. Run out and spend it as fast as you darn well can, because that way, by that time you're gonna see the dollar. The dollar's going to be toast if they continue with, and there's no other choice. They got to continue into these programs. This is the only way to keep the economy from absolutely crashing into a black hole, and from them all to lose their jobs, or worse, And so they have to. They're forced to. If they want to, and also it makes them be the good guys. Then they're the guys handing out the checks. It gives a power squarely in their corner, And this is the direction it's moving, guys. Listen, thank you guys for listening to my show. Like and subscribe, give me a thumbs up and all that good stuff. I really appreciate that. Really appreciate my audience out there. And bye-bye, guys, and we'll see you tomorrow.